Tax evasion is illegal. But do you know that there are legally allowed ways to reduce your tax bill every year? In today's video, we're going to look at tips and techniques and the type of deduction you can avail to reduce your tax bill in the end of year. Taxes may be an inevitable part of life, but most people would probably rather not hand over a portion of their earnings to the government. Fortunately, there are several completely legal ways to lower the amount you pay the taxman each year. These include credits, deductions, and advanced investment strategies. The tax code can and does change frequently, but here is a look at how to pay less taxes based on current law. The first way is through retirement account contributions. Retirement account contributions are one of the easiest ways to save on taxes, and its strategy can be used by almost everyone. Contributions to the traditional 401k and IRA accounts can be deducted from your taxable income and, as a result, reduce the amount of federal tax you owe. These funds also grow tax-free until retirement. There are also Roth IRA accounts that are funded with after-tax dollars. While you don't get a tax deduction, money in the account grows tax-free and can be withdrawn tax-free in retirement. While contributions to workplace 401k accounts must be made by the end of the calendar year, tax-deductible contributions can be made to traditional IRAs up until the next tax filing deadline. The second way is to open a health savings account. If you have an eligible high-deductible medical plan, contributing to a health savings account is another way to lower taxable income. Contribution to these accounts offer immediate tax deduction, grow tax deferred, and can be withdrawn tax-free for qualified medical expenses. Any balance left at the end of the year can roll over indefinitely, similar to assets in retirement account. Third way is to check for flexible spending accounts at work. If you don't have a high deductible health insurance plan, you can still pay for medical expenses with tax-free dollars if your employer offers flexible spending accounts. FSAs use payroll deduction to fund an account, which can then be used to pay for expenses ranging from insurance copays to dental cleanings to over-the-counter medication. Many employers offer FSAs for both healthcare and dependent care. In both cases, there are limits to how much you can deposit, and money may be forfeited if not used by the end of the year. The fourth way is to get credit for higher education. The government offers valuable tax credits to offset the cost of higher education. The American Opportunity Tax Credit can be claimed for the first 4 years of college and provides a maximum credit of $2,500 per student per year. Since it's a credit, that amount is deducted from whatever tax you might owe the government. If it exceeds the amount of taxes you owe, up to $1,000 may be refundable to you. Meanwhile, the Lifetime Learning Credit is great for adults, boosting their education and training. This credit is worth up to $2,000 per year and helps pay for college and educational expenses that improve your job skill. The fifth way is to contribute to a 529 plan. If you have children or plan to go back to school yourself, open a 529 plan for college savings. While there is no federal tax break for contributions, some states allow residents to deduct contributions on their state income taxes. Withdrawals from accounts are tax exempt as long as they are used for qualified education purposes. If your child doesn't go to school or doesn't need all the money, it can be assigned to another beneficiary, or you can use up to $10,000 to repay student loan. New this year is the option to transfer money from these accounts to a retirement fund. The Secure Act 2.0 made it very attractive in that you can convert some of the 529 savings to a Roth account. The sixth way is to see if you qualify for an earned income tax credit. Even if you aren't required to pay federal income taxes, you could get a refund from the government. The earned income tax credit is a refundable tax credit of up to $7,430 for tax year 2023. The earned income tax credit is calculated with a formula that takes into consideration income and family size. For 2023, the income limits for the credit range from $17,640 for single taxpayers with no children to $63,698 for a married couple filing jointly who have 3 or more children. Seventh way is to itemize state sales tax. Taxpayers who itemize their deductions can include either their state income tax or state sales tax on their Schedule A form. The state sales tax break is a great option if you live in a state without income taxes. While taxpayers can use a table provided by the IRS to easily claim their sales tax deduction, people should remember to add the sales tax from any major purchase such as a car or boat. The federal tax deduction for state and local taxes is capped at $10,000 from all sources. The eighth way is to make charitable donations. Charitable donations made with the payroll deductions, checks, cash, and donations of goods and clothing are all deductible. You generally need to itemize to claim a deduction. And since the 2017 tax reform nearly doubled the standard deduction, many people choose not to itemize. As an alternative, those with the means can set up a donor advised fund. Contribution to these funds are deductible in the year they are made. But then donations can be sent to charities over the course of many years. It allows taxpayers to bundle several years' worth of donations into a single year and opens the door to itemizing deductions. The ninth way is to donate your required minimum distribution. Another way to support charities and lower your tax liability at the same time is to donate required minimum distributions known as RMDs from retirement accounts. At age 73, retirees need to begin taking RMD from traditional retirement accounts such as 401k plans and IRAs. This money is taxable and depending on the amount, it could add significantly to a person's overall tax. Making a qualified charitable distribution is one way to bypass these taxes. Assuming you don't need the money from the RMD, it can be sent directly to a qualified charity, which makes the distribution tax exempt. The 10th way is to adjust your basis for capital gains tax. If you are an investor calculating the cost basis after selling a financial asset, make sure to add in all of the reinvested dividends. That increases the cost basis and reduces your capital gain when you sell the investment. If you sell your house, you may end up paying capital gains tax as well, particularly if your property's value has risen significantly. Single taxpayers can exempt up to $250,000 of their home's appreciation from the capital gains tax, while married couples get a $500,000 exemption. The IRS only allows this exemption to be claimed once every 2 years. However, you can reduce how much you owe if you have made home renovations or improvements. The 11th way is to avoid capital gains tax by donating stock. Another way to avoid capital gains tax is to use stocks for charitable gifts. Doing so allows you to skip paying capital gains tax on the appreciated value while also supporting the charity of your choice. If you want to keep a stock or a fund in your portfolio, you can simply buy more and reset the cost basis for yourself. Many people use donor advised funds to donate stocks, but you can make a gift without one. Talk to the charity of your choice to see if they accept securities. If so, they will likely have a staff who can walk you through the process. The 12th way is to claim deductions for military members. Are you in the military reserves, such as the National Guard? If you travel more than 100 miles from home and need to be away overnight, you can deduct unreimbursed travel expenses such as transportation, meals, and lodging. If you are an active duty service member, you can deduct any costs associated with moving for a permanent change of station. The 13th way is to make energy efficient updates. The Inflation Reduction Act of 2022 extended and expanded federal tax credit for energy efficiency updates made to homes and businesses. Now through 2032, homeowners can claim up to $3,200 annually in credits for certain home improvements, such as installing heat pumps, energy efficient windows and doors, installation and similar upgrades. A separate credit is offered for the installation of solar panels, wind energy and geothermal systems as well as battery storage. 14th way is to write off your gambling losses. Gamblers who hit it big will need to pay taxes on their winnings, but there is a way to reduce how much is owed. Keep records and use your losses to offset the gains at the tax time. And the 15th way is state and local tax breaks. State and local taxes can add up, so don't forget to look for ways to reduce your tax burden there as well. While the federal tax reform law eliminated miscellaneous deductions, many states still allow them, or they may have a lower threshold for claiming them. For instance, in New Jersey, taxpayers can deduct the cost of medical expenses exceeding 2% of their adjusted gross income. On federal tax forms, only medical expenses of more than 7.5% of a person's income are deductible. The bottom line is, contrary to what most people think, tax avoidance is a very legal way to avoid paying too much in taxes. There are different strategies in place that you can use to completely avoid paying or lower your tax liability. But don't confuse it with tax evasion, which is illegal. When in doubt, consult a tax or a financial professional about how to ensure that you are following the tax law. Subscribe to our channel so that you won't miss any of our videos on personal finance and you get notified.